Request. They're a world leader in the design and development of narrowband RF mesh networks that enable Omni-Internet of Things communications. I don't know why this has been selling off. I suspect it's something to do with funds, and I said that before. So who is this? This is Crux. Yeah, they've taken a bit off, but that wouldn't explain 1670. That's today and yesterday. So what that wouldn't explain the fall off. I mean, so upside 66%. I think it was more than that actually. But if you look at the so let's have a look at cash. They had no. Okay, well, let's have a look. I mean, did they raise money? I'm sure they raised money. Placing and subscription at 2.5, and that was in November. So we went in December, January, February, March, April. 5 months. Yes, you can see pretty much in 6 months on an EBITDA level, 2 million. So yeah, so literally, cash used in operations 2.7. So that says to me they need cash if they're at current cash burn, and that's why I think the share price is weak. So it's one of those things where it may be worth getting in if you believe them, after this, if they start going uptrend, of course, sticking to the rules. Because look at the top line growth is quite impressive: 35%, 107%, 24%. And then they start becoming profitable, it says, the brokers, in 2025. Now, so that would say to me, if they raise some money here, I mean, they're going to need to raise, another 6 months worth, but 3-4 million to be safe, maybe? Then they'd get to profitability if everything goes to plan. They've got orders, which I quite like. It's a bit like SRT. They've got orders. SRT have raised money, but they have got orders, apparently. So the fulfillment of these orders will drive this revenue. So it's not like they're hoping to get there. So I think there's potential there. I mean, my upside is almost for 2026, 200%. Billington. Let's look at the chat. So Bill, I just jumped into this because I thought the trend update was great. There, I think it was. I jumped in on that day. And there isn't a bit, but I mean, you've got this gap. It may come down to that, but I'm not too worried because if it comes down to that, and I've got only 1% in, I'm not too bothered as long as that's not because what happens then is, let's say I got in here, comes down 12%, even 14%. What happens then is that it becomes better value and the potential goes up. And like I said, it's a healthy company with a good balance sheet. It's not like a pop and drop stock. So I'd be surprised if it comes down here. It's got a 3% dividend as well. So, stocks like that, they're generating cash. That just becomes good value then. It starts to rally again above 200 maybe, and then it's backing up trend. So it's companies you can go on for years doing very well. But Billington. So look at that, market cap 61, enterprise value 39. I like that. Do you? No debt, and yet it's got 22 million of cash. There's a level of safety right there. How much is it going to come down? It's got a dividend yield of 3.13. It's got 22 million of cash, and it made an operating profit of 13. That cash is going to keep going up. So to a certain extent, I can't see it coming back too much. If it comes back down here, fine. The valuation gets better. It's more compelling. The potential goes up. And then, apart from efficiency, it would move up the league. It's very clever, that, isn't it? I like that. So the potential will go up. The valuation will get better. But even that, the valuation is quite good anyway. Look at this. All green on the screen, apart from price to book. Not to worry about that too much. But the valuation is excellent. So the questionable thing is efficiency. They are sort of capital sort of intensive, but nevertheless, they're efficient. Look at that. Return on capital, 25%. And it's improved from the half year. So that's good. For a company with gross margins of 21, the capital return capital is very good. Momentum's all there. Broker target 27%. I'll take 27% and 3% dividend. It's fine. It's fine. And it keeps doing that. It keeps going up and landing new contracts. So yeah, it'll come back a bit. But listen, like I said, start off small whenever you first come. That's one of the things, when you're thinking about things, you realize when you make your initial investment, you don't know what it's going to do. You hope it's going to go up. So keep it small. And when it starts winning, then, you realize, okay. And I give the analogy of, let's say you have 5 seeds and 5 plant pots, okay? And you put a seed in each plant pot. and you water them all equally. Then 3 start to sprout, and 2 don't. All right? And then one of the 3 starts really going up. Now, what do? You start watering the ones that haven't seeded, the losers, keep watering them, ignore the winners, or do you water the winners and, in fact, give more water to the big winner because it's going to need more? That's the same with stocks, really. You get the stocks rising, people, they don't go unnoticed. Once a riser starts rising, people start looking at it, thinking, that's good value and good growth there. And they start piling into it. The momentum picks up. So it's like the old thing, isn't it? Private investors tend to water their weeds and cut their winners and cut their flowers, I mean. So don't do that. And so, this kind of thing, it's obviously a bit of a flower. It may have to come in, it may have to grow into the valuation and come back a little bit. But as a business, it's very robust. It's got plenty of cash. It's generating cash, pays a dividend. And so it's nice, I think. It's a quality company. I've been knowing this company for a while. They've got basically an app that helps people do workflow. So their customers are like supermarkets, trains, whatever, train companies, and the employees who do this stuff that find it hard to monitor. They monitor it by literally ticking off these. They give a cleaner in Tesco's, for example, a little app called, what's it called, MPro 5, and they tick off what they've done, and they can monitor how fast they did the work, and they can recheck it and all that stuff. So it is quality control, digitized, pretty much. There's quite a few companies like this out there. I mean, Check-It's very similar. The trouble with these companies, or the good thing about these companies, is they've got high recurring revenue because they've got the software as a service contract. Now, but these contracts aren't big, but when you start getting a bit of steam up, and they start building up, and as long as you don't get too many companies, cancelling, then it's a good model. You just add to the hopper, pretty much. So, for example, let's say they'll win a contract with 300 grand over 3 years. That's nothing, is it? You think that's nothing. But you start winning 10 of those, 20 of those, and they start piling up, and very few cancellations happen. It starts building up, and the gross margin is very good. So these companies do take a while to get going, but once they get going, and I think if you look at the results here on Crimson Tide, I think it's worth looking at because it's been around for a while. The broker target is like they are. I mean, just have a look at this. The broker target are quite big. It's like, let me go back to Crimson Tide. So it's one of those companies. So if you look at this, the problem is now how I look at volume. Like I said, is I put them in figures as well as amounts. So that's times by the share price. And in my mind, be careful about taking big positions in companies like this because if something goes wrong, you can have a problem getting out. And I tend to do 10% of the average daily volume. If you've got a size bigger than that, then you may have problems getting out the really good news. And so that's 560 quid. So, it's not a huge position. Of course, this volume will build if the company starts doing well. The share price starts going, it'll build. But just why I say that is because, I like to get, if I'm buying something, and sometimes selling something, normally I use stop losses, or I will use stop losses, but sometimes I want to sell and get a live quote. Now, if a company comes up with bad news, and so on a normal day, so no news day, for example, say the average liquidity would be, say, 50% buys, 50% sells if the share price is going nowhere. On a good news day, of course, the liquidity would go up, more shares be traded, and you get, say, 67% buyers, even up to 80, 90% maybe. So that's a good day to sell, because, of course, you got lots of demand for your shares, and market makers don't hold that many shares and saying, okay, we've got lots of buyers here, and so you'll do very well, you get a good price for it. But, of course, no one's going to sell on a good day, good news, when the share price is going up. When people tend to sell, and the news is bad, it goes down. Okay, so on a day like that, liquidity would go up. So you may see like 10 grand's worth of, 20 grand's worth of stock traded, maybe. But it's the flip side problem. You've got like literally everyone rushing for the exit, and you can't all fit through it in one go. So 90% of people selling, there's only 10% buyers. You think, so just be aware of small companies are liquid, how much size you've got. Because having said that, I wouldn't expect the companies with a recurring revenue have less surprises, nasty surprises, because of course they have more recurring revenue. So that's why brokers tend to give them more upside, like 212%, because a lot of it is visible. The transparency of revenue, you can see it. Forward visibility is very good. What I'm trying to say. Anyway, so 31st of 12th results. They are I capped 10 million. They got cash. They got no debt. That's good. $1 million of cash. Sorry, how much cash they got? It's 3.2, so decent amount of cash there. I'm quite liking this. If you look at the forecasts, if you can believe the forecasts, because the growth is 15%, okay? Last half year, so the second half wasn't as good as the first half. But then the operating profit growth is good. You know, they're not cheap, but if they improve, I mean, that'll get better. I like this look. So operating margin, 86%. Eventually, of course, that drops down. Um, Momentum isn't there. But so they did 6 million in revenue, up from 5.3. Gross, they did lose. EBITDA was positive, but everything else, a little bit of a loss. But they got plenty of cash there. So they got cash. Um, yeah, downtrend though. But I mean, forecast. So let's look at the forecast. So they're saying it's a nice gradual rise, and that's where software as a service, it's very rare to get software as a service companies, knocking out the ballpark, like 30-40% top line growth, because it's a nice, steady, gradual rise. But also, look at this, the margins, start to get better. The growth happens, and the margins start, look at the margins here, 15.8% EBITDA, 23.33. So they really start kicking in. And even, the pre-tax margins, 5, 9, 22. Wow. This is from, I don't know how they're getting 22 from that, but there we are. Maybe tax rebate for some reason. But nevertheless, so I see a little bit of upside here. If they achieve that, I got 146%. And this is basing it on 1.3, 10, 15, because, not huge multiples, not low, because they're recurring. So maybe potentially it's too small for me, really, because there's no liquidity. Maybe they'll pick up, but again, there's no momentum there. Momentum is 1/3 the way there. But yeah, maybe worth a look at Crimson. I don't know. I don't know what you think, but maybe one for the watch list.